Are you ready to take your investment game to the next level? Introducing Digital Investor, your ultimate guide to mastering the digital marketplace. Whether you're a seasoned pro or just starting out, Digital Investor brings you cutting-edge game theoretical strategies, expert insights, and real-time tips and tactics to analyze, evaluate, invest, and grow your wealth. Don't miss out on the digital revolution. Visit www.nickblacknext.com and start your journey with Digital Investor today.
We got it. Hello. Make it a little bit more quiet. Not too much. We determine 11. 11's perfect. All right. Hello. So, let me see. Do we have any updates other than this coffee is called Vanilla Dream? Yeah, you're right. It's as good as it sounds. Hi, kitty. We've been chasing down the big cat all morning because he's been tumping over all the plants in the house. All the potted plants. All the potted plants. He thinks it's funny. Anyway. First world problems. Okay. We don't have a firm date yet for GMRT for the launch, but we think their mainnet launch is going to be in the middle, towards the end of April. Well, we're already almost at the middle of March. So about a month to 6 weeks away should be their mainnet launch. And I'm sure there'll be a lot of cool media and propaganda and stuff around that. So we'll see. All right. We don't have a launch date yet for Libra, but we are finishing up the last little bit of raising money for equity for them. And then I guess they're going to use that money for exchange fees and listing fees and all that, because the way it works in the crypto space is if you want to be on exchange, you have to pay to play. Not only do you have to give them, the exchange, a bunch of tokens, you also have to pay them a fee, money straight into their pocket, cash. Here, take this money, list our stuff. That's the way it works. You got to pay to play, which I guess the exchange is like, look, if we're going to do all the work to list the token and all the pairs and all the blah, 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 give us some money, whatever. But that's the way the world works. So, yeah, money. So that will be wrapped up today or tomorrow. Yeah, that's all that kind of news. Hypercycle news. I mean, the best place to go is to go to the Hypercycle chats. I mean, I say that, but those chat groups are terrible. So maybe get your information a little bit from everywhere. How about that? But they are supposed to be doing some new technology stuff, like releasing some new software and things like that here in the coming days. So that'll be kind of nice, as well as an educational program. There's like a really quick 8-minute program for developers, an 8-hour program for like the rest of us, and then like an 8 day program for super nitty gritty in the weeds developers that, so they can deploy stuff for big companies, things like that. So that's coming. So that's good. Education is key. All right. So what I've got on the agenda is I was looking over, I don't know if any of you guys are following what's going on with this. There is on Hyperliquid. Does anybody here, show of hands through your comments, does anybody here know what's been going on with Hyperliquid? There's a guy that went in with leverage. He went, so the first time what he did is he went 50x long on an Ethereum play. So long Ethereum, 50x, 50, like 50x, long leverage with a lot of money. Then he borrowed against his position in the liquidity pool and basically nuked their pool, took out kind of a bad loan, repaid back his unwound his leverage position, or got margin called. It didn't even matter. I think he got margin called, it wouldn't be I guess technically it's a margin call, but anyway, he got called, he got nuked, but it didn't matter because he ended up making $4 million on the trade because he hit the liquidity pool. Well, guess who's back at it and put on another position? Some fat ass leverage. And this time I think he went, and I'll get to the article, but I think he went again, leverage long on Ethereum, and he went short on Bitcoin. So, this sounds bad to say, but there's money to be made in learning the rules on these DeFi platforms. And when you find out that the developers maybe haven't thought everything through, you can take advantage of that. And it seems like that's what this guy's done. So we'll get into this. It's pretty interesting stuff. We're also going to talk about Tom Emmer, Representative Tom Emmer, saying that CBDC technology is inherently un-American. It's un-American, I say. All right. And Warren Buffett wins again. Everybody else is getting their clocks cleaned except for Warren Buffett, who about 8 or 9 months ago started selling bank stocks and what kind of little representation he had in technology and things like that. And now he's the only one who's not getting just whacked. And everybody on Wall Street's getting their clocks cleaned. So we'll talk about that too. But first, you got to be very careful in liquidity pools. Liquidity pools can be the end of his. So let's start with Hyperliquid. So a Hyperliquid whale trader strikes again. That sounds like some kind of cool. Anyway, Hyperliquid was something I had read about it. It seems kind of spammy. It got a lot of attention. It still seems spammy. And I was like, I'm going to take another look. Maybe I'm just not being fair. And then the next article I read is that they're getting whacked because they're not very good at math, because they extend too much leverage. So anyway, this guy's at it again, this time with another long Ethereum attack on the community vault. And so I'll give you the blurbs, and then we'll kind of go into it a little bit. It's a little tricky, so you have to kind of hold on to it in your mind. But this trader had drained one of Hyperliquid's vaults, again, with a long Ethereum trade, but then borrowing against it, getting liquidated, and it didn't matter. So he has a new leverage position on both Ethereum and Bitcoin. And of course, the CEO of Bybit, who themselves just got drained, he believes Hyperliquid is still vulnerable to liquidations. To which I would say, hey, Ben Zhu of Bybit, why don't you worry about getting your own house in order and the $1.46 billion you guys lost? Why don't you focus on that instead of throwing shade at other projects? But he is right on this one. Anyway, the derivative DEX lowered its leverage limits in a bid to avoid similar liquidation. So they had tried to fix last weekend's problem by dropping the leverage down. I think they went from 50, they reduced it to 40 and 25x, which doesn't seem that dramatic. I think maybe down to 25x. I think that was the Ethereum. You could only go 25x on Ethereum. So anyway, The risk quoting trader who caused outsized losses for one of Hyperliquid's pools is back at it again with another Ethereum long position. This time, he's using just a meager 25x leverage, posing a potential risk for the exchange. So the trader who had caused over $4 million in lost liquidity for Hyperliquid's pool is back again. This time, he has a long position on Ethereum. However, the trader switched quickly between risky short and long positions on Ethereum. So once again, exposing the exchange to potential liquidations. Following the news, the Hype native token, HYPE, which a lot of people were super excited about, has been sliding, as it should. When your only job in the world is to create a platform that exposes various amounts of leverage safely, and you can't do it, and you get nuked by the same dude twice, come on, man. You shouldn't have your own goddamn token. Two, you shouldn't be in the math business. Anyway, the new batch of positions that this trader's put on are smaller. So the whale deposited $2.3 million into Hyperliquid. He, at 25x leverage, the position could still be quite outsized because it's not certain that pool could handle that. So the position on the whale's Hyperliquid account were still active as the crypto market entered another period of, volatility. So he has a short position on Bitcoin with 40x leverage. And he has a long position on Ethereum with 25x leverage. Yeah. So his entry point on Ethereum, for all you home gamers, was 1,886. And so he's up, $10 on that. So, 25x leverage, you're not getting rich off that trade yet. Then he, in his Bitcoin position, his entry was 83,109. The price is 82.8. So he's almost 250, $300 on the good side on his short position. So he's correct on both right now. Although technically he owes a little bit on the Ethereum trade because it's so tight, that margin's so tight that he's only up a little bit. So here's what would happen at $1,806. So if Ethereum goes down to $1,806, he gets wiped, totally liquidated. If Bitcoin goes up to 86,800, he gets wiped, totally liquidated. The value of those positions, let's see, with leverage is just shy of 60 million bucks, like a couple pennies shy of 60 million bucks. So it's essentially a 16,000 Ethereum position, 16,173, and almost a 348 Bitcoin position. Yeesh. Am I right? Anyway, on-chain data reveals that the whale also moved through GMX, making a $4 million USDC deposit. Initially, the whale shorted Ethereum, but then closed the position and moved long on the asset. The whale secured $177,000 gain through that position before shifting to Hyperliquid again. The Hyperliquid community vault still carries much lower liquidity after taking over the whale's initial Ethereum long after it liquidated over the weekend. The whale's new position longed Ethereum at 25x, shorted Bitcoin with 40x leverage. It uses the maximum available leverage on Hyperliquid. And this is even after they lowered the limit. So previously the whale took riskier positions at 50x. So, and he is still in the green after Bitcoin and Ethereum markets move. So hours after setting up the leverage positions, the trader was still in the money. The positions were in profit after Ethereum recovered, while Bitcoin slipped under 83,000. As of March 13th, Ethereum traded right around 1898, while Bitcoin stepped back to 82,952. I haven't looked at the current prices in a few minutes, so let me see if I can see where he would be at this second. Where he be? So Bitcoin's at 81.5. His short position appears to be doing just fine. And his long position, 1875 on Ethereum, he's okay there too. So, yeah, he's nowhere near liquidation on Bitcoin. He's just making money on that trade. Well, what? Anyway, the whale's position posted relatively small gains above about 100, right around 200 or 300,000. However, the Ethereum, I know that sounds small when you're talking about many millions. The Ethereum funding rate turned red for the long position. So what happens is with Ethereum, well, you have to manage these positions. There's a funding rate. And when you take these leveraged positions, you have to manage about every 8 hours. Depends on the exchange. But about every 8 hours, there's a funding rate that you have to pay. Now, sometimes the interval is shorter, sometimes the interval is longer, but you're going to have a funding rate that you have to cover all the time to keep these leveraged positions open. It's kind of like you're paying insurance, but it's not insurance for you. It's for them. If you stop paying, they start selling your position. So the whale had entered the position on Ethereum at 1,886 per ETH. And right now at 1878, it's right at the liquidation level, meaning without an almost immediate rally, the whale threatened to leave Hyperliquid with another toxic liquidated position. Ethereum is currently trying to hold well, it hasn't. It's at 1879. It was trying to hold 1887 support, where traders have posted, the biggest accumulation of liquidity. Ethereum remains quite risky when it comes to liquidations, with 8.2 million in total liquidation. Then this is just in the last few hours. Ethereum saw 4.8 million in long liquidations in the last 4 hours. 3.42 million in short liquidations. That means people are losing on both sides, and the fact that those numbers are so close means the bookies are doing the right thing. The bookies have it right. So the risk for long positions remains outsized, as Ethereum has been facing a long drawdown in the past 3 months, as we all know, this kind of grinding, slow kick in the nuts. A rebound was expected, but always seems to be delayed by some deeper price slide. So, sometimes the lowest point of the day is the highest point of the next day. Under these conditions, an unexpected rally would benefit leverage whales the most, but yeah, I mean, I'd say all rallies are unexpected, because if you expected them, they'd already be priced and there'd be no rally. So anyway, Bybit's CEO, the guy who knows how to lose money professionally, Ben Zhu, who really shouldn't be commenting on anything ever. This is a guy that got bailed out by all these other exchanges after, let's face it, they blew it. Anyway, he believes, as an oracle of truth, he believes that the whale was intentional in letting a large leverage position be liquidated. He sees the high leverage trade as a potential problem for both DEX and centralized market operators. Zhu believes, what do Zhu believe? Zhu believes the whale chose an easy way to exit through a liquidation. So essentially, what happened was this whale used Hyperliquid's liquidation engine as his exit. So imagine you have a $300 million long position on Ethereum, and you have $15 million margin on 50x leverage. So what is the quickest way to exit? Just get liquidated. You're out. So what Zhu proposed is his solution is large positions have their leverage lowered automatically. And this would not allow whales to exploit the available liquidity and saddle exchanges with toxic debt. So Zhu believes, Z-H-O-U, Zhao, maybe it's Zhao. He also believes that lowered leverage thresholds on Hyperliquid are still open to manipulation. The other potential attack vector is to create multiple accounts, which the exchange is trying to discourage through screening, but basically you would create a bunch of different accounts, and then you would put on a bunch of different positions that equal the same big position. They're not going to stop someone who's diligent about doing this stuff. But because of its large leverage, Hyperliquid is still, competitive, and that if they lower the leverage, the company doesn't seem interesting. Like, there's nothing interesting about Hyperliquid or what they do if they have normal leverage, the same as any other exchange. So because of this, the DEX is vulnerable to these kinds of attacks. And the recent liquidation that happened, hurt the Hyperliquid community, which used the vault for passive income. So they put money in the vault, these kind of passive plays. Remember, if someone's paying you more than 6%, there must be a reason, there must be an explanation, and there must be some level of risk higher than junk bonds. Think about it. If junk pays you 6, if you're getting paid more than 6 anywhere for any reason, you need to at least ask why. Now, if it's a company issuing their own asset, they can issue it until there's no more asset left. Fair play. But if they're claiming to give you currency units denominated in dollars over 6%, well then, they need an explanation for how they do that. These guys have a shitload of leverage that they give to a shitload of degens. To me, that sounds like a recipe for disaster. And again, if they lower the leverage, it's not that interesting and no one cares. So I think the guys at Hyperliquid put an idea together that sounds cool on paper until anybody with a fucking 3rd grade math background scribbles on some napkins and says, oh, wait, this will never work. You're like, yeah, too late, bro. They already sold the token and they're all rich. So guess what? The people at Hyperliquid, they don't give a shit. They do not care. They're already rich, bro. If you destroy their community, if everybody left Hyperliquid right now and the token went to 0, those dudes have already cashed the F out. 1-0. Hyperliquid, 1-0. How does it correlate to JLP? Not at all. Like not at all. JLP is not a leverage platform. Hyperliquid, their whole thing is extending leverage and letting people get trade degen. But anyway, these guys that had parked money at Hyperliquid for passive income, remember, they're basically the lenders for this bullshit. You're a lender. The involvement of this high-risk trader was kind of a black swan for the vault because they had never seen anything like this. And they had accrued about 4.8 million in liquidity, and it's gone. I think they lost over 4.2 million. All gone. Because if you're an exchange that only offers leverage and you're backing that with a liquidity vault, guess what? If the leverage gets nuked, you get nuked. So Hyperliquid, #fail. Is there any way to fix it? Probably not. Because if Hyperliquid lowers their leverage rates to be competitive, they're no longer interesting. To the point where people can't nuke their pools, they're no longer competitive and no one's interested. So see you later, bye. Hyperliquid. Am I right? All right, let's see. I mean, too upset. I haven't been myself. Oh, Howard, buddy, we assume you're on so much medication that you have little or no clue what you're saying from one moment to the next, but we still love you, Howard. Okay, let's move along. Let's talk Tom Emmer. Hold on, let me see if I can go to the Lexicon. It's a little bit that's too vibey. There we go. We'll go to that one. That's better. Okay. Representative Tom Emmer is asserting that CBDC technology is inherently un-American. As debate intensifies on digital currency regulation, lawmakers challenge state-sponsored payment systems for their potential to compromise financial privacy and market freedom. I think that's funny when politicians and government officials are telling us about financial privacy and market freedom, the things that they routinely step on all the time. Ask Nancy Pelosi about market freedom. Cheating inside trading cunt. Anyway, did I say that out loud? I can say that now. Trump got elected. Anyway, takeaways. Critics warn that government-controlled digital money might erode private safeguards. Yeah, but guess what? We already have digital money. It's already government-controlled. The same stuff, bro. We're already here. We already have digital money. It's weird that people don't get this. The government's not like taking duffel bags full of cash and burning it and converting it into tax. Like, come on. Some favor a private sector model, like kind of the system that we currently have, where you have less intrusive digital payments across rails, like stablecoins, like USDC and the crap known as USDT. New proposals seek to curb state influence over payment systems. That part's good, but I mean, seems a little suspicious when Tether itself can freeze your money. And this discussion fuels broader efforts to refresh digital financial regulations. Great. So House Majority Whip Tom Emmer he's a Republican, criticized central bank digital currencies, CBDCs, during a House Financial Service Committee hearing on March 11th. He argued that they pose a threat to Americans' financial privacy. Well, yeah, that's true. I wonder how Jerome and the douchebaggery over at the Fed, I wonder if they think, hey, wait a minute. Every time they talk about this, they're really just calling us out and saying that they don't trust the Fed and that they don't really trust the Treasury. Yes, that's what they're saying, Jerome. Nobody fucking trusts you. They all think you're a joke. You have big ears. They don't say that. They think it, though. The big ear part, they think it. Anyway, Tom Emmer takes a swipe at CBDCs during a Navigating the Digital Payments Ecosystem, examining a federal framework for payment stablecoins and consequences of a U.S. CBDC discussion. Woo! What a discussion. Man, when the title of your discussion is a paragraph, bro, you guys need to tighten it up. Emmer claimed that the risks of a CBDC would undermine American privacy. He said, CBDCs introduce significant privacy risks and are fundamentally the antithesis of American values. I don't know if he said it that way. He probably didn't. But anyway, I like to think that he did. That he comes from the deep south. Anyway, so his criticism of CBDCs, you say it fast, you win a prize. CBDCs come as lawmakers debate the regulatory future of digital payments, including stablecoins. And this is where you've seen the CEO of Tether coming out everywhere. Hey, this is not fair. You guys are being mean to us. Shut up, you counterfeiting piece of shit. I don't know why he's even mad. Those guys all got wealthy. Like, just go away. Take your money and go away. Shut the fuck up. Like, let Tether die where it should die, because it's a scam. But no, he's gonna fight. I'm gonna fight. I'll talk. We're gonna live. We're gonna survive. All right, whatever. The hearing largely centered around the Stable Act, and this is legislation that was introduced by Representative Brian Steele, Republican, and Chair Committee French Hill, also Republican, which aims to establish clear regulations for stablecoins in the United States. And quote, on the other hand, this stablecoin bill can bring traditional finance on chain at a global scale while preserving privacy, individual sovereignty, and free market competitiveness. What is that? There's no such thing as free markets anymore. What a joke. Anyway, Emmer added, this underscores why we must prioritize pro-stablecoin legislation alongside anti-CBDC legislation. Again, I love it. The shot at Jerome Powell. It's like, hey, we're going to let these yahoos who basically counterfeit, we'd rather let them survive than let you over at the Fed have your finger on anything that looks like real money. This is why when people are like, oh, the Fed's printing again, you can say, this is another example of how you can say, the Fed doesn't deal in money. The government is so scared that they might actually deal in money that they're creating legislation that specifically says the Federal Reserve can't have it. Cannot. No central bank digital. Who do you think they're talking about? What's the CB in CBDC? I mean, if the Fed was a real central bank, it'd be them. But it's not. But it is them. When you're saying no American CBDCs, you're saying, hey, Jerome, you're not touching real money ever, you fucking creep. Anyway, so I think this is good. Their heart's in the right place. Congress debates CBDCs and stablecoin regulation pretty routinely lately. News of the hearing comes 1 week after Emmer reintroduced his anti-CBDC Surveillance State Act. That sounds nasty. Which would prevent the federal government from directly issuing a CBDC to individuals. In a March 6th press release, Emmer argued that allowing the government to issue, again, Jerome Powell, even though he's not part of the government, people don't realize this. The central bank in America is neither central, nor is it, the Fed isn't really a bank. They don't deal in money. They deal in IOUs and bank reserves and overnight lending rates. But all of that shit's financed by the Treasury. The Fed doesn't do any of it. They collect revenue. The Fed is 12 private banks that are not part of the U.S. government. The Board of Governors, which is the representatives, they're on a body that reports to Congress. Well, one of them reports to Congress. But that body is not the banks. The banks are private, for-profit institutions. Everyone should know this. You can go read the inception of all this, the creature from Jekyll Island, I believe that's what the book was. Anyway, he said that allowing the government to issue a CBDC would be unethical, as it would give authorities like Jerome Powell the ability to collect personal financial data from Americans. If not designed to be open, permissionless, and private, resembling cash, a government-issued CBDC is nothing more than an Orwellian surveillance tool that would be used to erode the American way of life. I would tell Emmer to have added the word further erode the American way of life. That's just me. Just one guy. I don't want to be that old, armchair editor. That's not what I'm about. Anyway, the Senate Banking Committee is set to vote on Senator Bill Hagerty's Genius Act. I love how they name these things. The Genius Act, Thursday, so today. And this is a bill that seeks to establish a regulatory framework for payment stablecoins, which is important. And this is the thing that all of the guys from Tether are panicking about. No. Like, oh, you mean the fact that you might be audited and have to prove where all the money is, if there's any money? No, this isn't fair. You're coming after us. Yeah, because they're going after counterfeiters, man. So the debate over stablecoin regulation continues as lawmakers consider how digital assets, including CBDCs, might fit into the broader financial system. The extent of federal regulatory power over digital assets remains a key issue in ongoing legislative discussions, with lawmakers divided over how much oversight should be imposed on emerging financial technologies. Interesting. So to sum it up, Emmer calls CBDC technology inherently un-American. He said that essentially CBDCs allow excessive government surveillance. It allows Jerome Powell into your house, basically. And it undermines privacy and personal freedom, which he believes contradicts American values. He has put forward legislation such as the CBDC Anti-Surveillance State Act, and this aims at preventing the Fed, at preventing Jerome Powell and his assholery from issuing a CBDC. And that is a good thing, because the Federal Reserve is not a central bank. It is private banks. It's no different than giving a bunch of money, letting Taco Bell print up their own currency, and letting Taco Bell print up US dollars. Taco dollars. Oh, taco dollars. We're going to workshop this. There might be something there. Anyway, what does the White House think about all this kind of stuff? Well, right now, Donald Trump has signed an executive order last month that would prohibit the creation of a CBDC, though lawmakers are looking to kind of formalize this vision in Congress. So everybody's of the same accord. Federal Reserve getting a hold of a CBDC, nope. And this is, again, it's not like Europe. This isn't the ECB. This isn't even the People's Bank of China. The Federal Reserve is not a real central bank. It's not even really the Federal Reserve itself. As the body, the Board of Governors that answers to Congress, they're nothing They're not a bank. They're not an institution. It's a bunch of dudes that claim to know what's going on because they have a bunch of PhDs that don't know shit either, that work for the Fed. The many thousands of people that work for the Fed that come up, that spin up useless information based on outdated data and draw the wrong conclusions every fucking time. This is the Fed. They were a joke. They were laughed at all the way until they reinvented this story of how the Federal Reserve got us out of the clutches of the hyperinflation, almost hyperinflation, the inflation of the 70s and 80s and all this kind of stuff. And so they just reinvented the past. But if you listen to anybody from the Fed, if you listen to, well, not Jerome Powell, he's still a liar right now. He's still a chump. But eventually he'll get clean. He'll come clean. He'll get clear. Bernanke said on multiple occasions, the Fed is 2% activity, 98% theater. Greenspan, same thing. He didn't even think there was any relationship, which there isn't, between interest rates and markets. He's like, it's not really clear what good interest rate changes actually do in the economy. There's no scholarship to show that there's any correlation at all. None. So, good. The Fed should not have actual currency units at their disposal. That would be sketch. Cole's cash. Why not taco dollars? Call them Valerians. Ooh. Well, no. This would be actual. This would be what they're trying to say is they're preventing the Fed from issuing U.S. dollars, like a stable U.S. dollar. This is preventing Taco Bell from issuing U.S. dollars and then doing international trade with them. I mean, I don't know. I hope if it's the Fed or Taco Bell, I hope it's Taco Bell. That's if I had a choice. Okay. Now we got to talk about Warren Buffett, because this dude, he's pretty good at being right. Let me put his old picture up there. Let's put old Warren's picture up here. He's earned it. He's earned a spot. Hold on. I'm gonna give him top billing. Buddy, you get top billing because you're a badass. You go, Warren. I'll go back to normal. Okay, so what's going on with Mr. Buffett? Well, he is again with kind of his long vision on markets, and I mean, this is the guy that plays the long game right now. He is the only person, it seems like, on Wall Street who's not in the red this second. Warren Buffett sold billions in stock, including Apple. He sold a bunch of banks, and this was before the market crash. He now holds $334 billion in cash. He must just be salivating, getting ready to rock and roll. So, Wall Street tanked after Trump's policies triggered fears of a recession, which is not Trump's fault. We were already in a recession. It's mind-numbing that people try to blame this tariff stuff. We've been in a recession. It's every single piece of data, except for your one-off BLS bullshit, every single piece of data. And by the way, the only reason the employment numbers weren't worse is because a ton of people fell off. You know how it works, right? Like after you've collected unemployment insurance for a certain amount of time, you fall off where you can no longer earn unemployment. They don't count you as unemployed. Now, you don't have a job, but you also don't get an unemployment check. So you just go away. So then it looks like, oh, unemployment's better than it is. No, because those people don't have a job. They're still unemployed. Oh, sorry. They are job insecure. Bitch, that's not insecure. That's unemployed. They broke. Soon they're going to be housing and food insecure. What does that mean? Oh, it means they got kicked out of their house. That means they're homeless. Oh, shit. Yeah. Housing insecure does sound better than homeless. Housing insecure is something that White House and politicians can say at a party. Oh, there's a lot of housing insecurity. Yeah, no, I agree. Rather than everybody's fucking homeless. Oh yeah, that doesn't sound good. You don't want to trade that between rosés at a Washington Gala. Housing insecure. You know what I am? I am Eggo waffle insecure. Oh, what does that mean? I ran out of Eggo waffles. I don't have any of them. I'm insecure of them. Everybody here, how many people we have? This will be fun. There's 147 people. I want everyone here to list one of your insecurities. Remember, that means you don't have it. What is something that you are insecure about? You know what? I'm a billionaire insecure. I'm not a billionaire. I don't have $1 billion. I'm $1 billion insecure. Shit. I'll never get there at this rate. Let's see. Lower rates allow businesses to borrow for less money. How? Remember, the rates that the Fed sets aren't the rates that you go borrow from. You're borrowing from banks, Joseph. So think about this. If you, well played, Craig. Well played. So Joseph, think about this for a second. Thought experiment. You go into a bank. You want to borrow money. Do you think the bank gives two shits what the Federal Reserve does at the overnight lending rate? When you're trying to borrow money for your business and pay it back, what, in 10 years? Or whatever rate that is? That's a negotiation between you and the bank. Now, in certain scenarios, for certain institutions, they may have a preferable overnight rate. And so they have a place to put their money overnight. But it's been shown that what the Fed does at the low end of the yield curve only affects debt around that area, around the low end of the yield curve. The rest of the curve doesn't just behave accordingly, because that's set by actual money dealers, people lending, borrowing, buying and selling in the market, and hedging behavior. That yield curve is telling you where people believe things to be based on hedging. That's hedging behavior, all, what would you say? All aggregated out, and there's your yield curve, right? If there's more people wanting to borrow, rates come down. If there's more people, if there's less borrowers, rates go up to entice more borrowing, right? So if a business is going to borrow, they're not going to borrow from the Fed. They're going to borrow from a bank, and a bank is a for-profit institution, and they're going to rate that loan accordingly. So it doesn't actually turn lower rates. If a bank was offering lower rates, yes, but the Federal Reserve is not that. So what the Federal Reserve does on the lower end of the yield curve, it doesn't affect banking behavior. Matter of fact, it may make banks more averse to lending, because those banks may say, fuck, why would I lend to Joseph if we can just park our money overnight over here? I'm not going to take any risk. Joseph, his company might not make it. We may never see that money again. We can't price this competitively enough to where he'll say, yes, he's not going to take money from us at 8%. Well, the overnight lending rate saw 4.2. Yeah, but you're asking for money for 10 years to start a business. So no, it just doesn't work that way. You'd think it would work that way, because remember, rates don't create business activity. Okay. Everybody needs to get this. Interest rates, Fed interest rates, they don't create activity. They are a reaction to activity. The Fed looks at situations and adjusts a rate. It doesn't matter for a very few people, and for everyone else, it really doesn't matter. And they always do it in arrears. It's always look at old data and react with interest rates. Look at old data and react with interest rates. Interest rates don't create the behavior. They're a reaction function to it. So that part you got to get. And once you get that, you're like, why do you see that in text? Because that's the inflation myth. That's the myth that's been propagated since the 1960s. Because people are fucking stupid, Joseph. And people would rather believe a myth if the myth makes them feel warm and fuzzy at night. If you believe the myth, if you believe bad information, but the bad information makes sense to you, because that's all you've been told, then when someone goes, That's not factually correct. You're like, you shut up. You talking about the world, the earth is not at the center of the universe. What do you know? I mean, that's just human nature. But all the scholarship and history and data exposes the myth, the inflation. There's two. There's the myth that inflation and unemployment are linked, and that the Phillips curve is sufficient to manage an economy. There's the myth that the kind of the interest rate fallacy, and all that stuff is exposed by Milton Friedman like over and over and over. Anyway, yeah, there. Not to get on that, but that's pretty important. It's important to understand that inflation adjustments are a reaction to the market. They're not the cause of it. And once you get that, then you're like, okay, got it. Yes, Satoshi, insecure, stacking, always stacking. Correct. All right, back to our boy Warren. Warren Buffett, a 94-year-old. Jesus, man, you talk about aged out. This guy makes people in Congress look young. Oh, those little young babies at 70 and 75 and 80. Those young whippersnappers. Anyway, he's the only major investor on Wall Street who isn't suffering right now. Elon Musk, Jeff Bezos, Mark Zuckerberg, Larry Page, Bill Gates, Larry Ellison, Barry Arnott, Michael Dell are all seeing billions wiped from their portfolio. Warren is sitting on $334 billion cash pile, untouched by the recent stock market kind of wind down. Well, it's not a full collapse, but it's pretty bad. Warren spent the last 9 quarters selling stock instead of buying, including massive exits from Apple, Bank of America, Citigroup. And people were like, what's he doing, man? Has he gone mad? But now, as Wall Street is tanking and tech stocks are crumbling under their own weight due to fears that Donald Trump's tariff policies and what did they say? The parade of the guy from one of the airlines, the parade of horribles. I mean, anyway, the whole trade war thing, it could send the economy into the recession that we're already in. Apparently, Warren seemed to know many months ago that this is where we were at. It seemed, why? Because Warren is old school and he does math, and he looked at the economy and he looked at the data and he called bullshit when it was bullshit. And he was like, no, we're clearly in a recession. These companies can't lie forever. At some point you can lie and you can big it up but at some point the numbers don't come in where you lied. Like, you can lie for a few quarters, but at some point the numbers just aren't there. And you have to go, oh yeah, well, we lose a lot of money. Yeah, we're wrong. We lose a lot of money. So what do? Is you lie for 3 or 4 quarters to support your stock price. You sell as much as you can. You sell as much as you can legally. And then you go, oh, we were wrong. We're terrible. And then the whole thing just gets fucking collapsed. Let me show you how much money these guys have lost. It's bad. If you ever think you're having a bad day, let's see if I can get this big. Can you see it? Can you see those? Can you see them numbers? Is that right? Or did I put that? Hold on. Let me make sure I did that right. Oh, no, I didn't. Hold on. There. Now you should be able to see it. I'll go small. Take a look. Feast your eyes. This is bad, man. Elon's at 300 billion. He's one day. Well, he lost 29 billion yesterday. He's down 131 billion on the year to date. It's only March. Jeff Bezos lost 4 billion yesterday. He's down 22 billion on the year. Mark Zuckerberg's not doing terrible. He did lose 9 billion yesterday, but he's still up 4 billion on the year. Bernard, he lost 1.25, although he's doing pretty good. He's up 6. Warren Buffett had an okay day, but he's had a pretty good year to date. He's up 13.5. So he's crushing. He's green and green. Bill Gates got whacked for $1 billion yesterday. He's still up 4.6. Good for Bill. Yeah. Ooh, Alice Walton. Man, God, can you imagine? Listen, anybody here imagine what it would feel like to wake up and you just look at your portfolio and you're down like a few billion. Michael Dell is down 20 billion first quarter of the year. Larry Ellison is down 23 billion. He lost 7 billion yesterday. Mark Zuckerberg, almost $10 billion yesterday. Vomit. Can you imagine? Whew. So, yeah, Warren, kind of a clever fella. The decision was confusing at first, but now that everybody's getting nuked, it makes a lot more sense what he was doing. So Warren saw, math. And while investors were still riding the highs of the Trump-driven rally, which there are things to be positive about, but you also knew that at some point we have to pay the piper. We're in a recession. You got to pay the man. So Warren started cashing out. Apple had just topped. He started selling. Wall Street was setting records. He was selling. Everyone thought stocks would keep climbing. Warren wasn't convinced. He started selling. He sold billions in Apple shares. He cut his stakes in Bank of America and Citigroup right before Trump took office. His cash reserves surged to $334 billion, making up 1/3 of Berkshire Hathaway's total portfolio. They're sitting on a mountain of cash. You ever want to know what to do in the market? Go look at what the richest people in the world are doing and start asking yourself why. Remember, Elon, Jeff, a lot of these guys aren't money managers. These guys are money makers. They come up with great ideas. The only one on that list that's a money manager is Warren, and Charlie would have been next to him, Charlie Munger. And that's their business, and they're good at it. And they have very long vision. They are value investors. A lot to be learned from these guys. So Monday, when the NASDAQ dropped by 4% in a single day, the biggest decline, by the way, in 3 years, tech got nuked. Investors that had doubled down on the AI bottom got just absolutely wiped. Wall Street panics. Warren does not. So Warren has been in the game long enough to know that when you bet really big and you see things changing, unwind the position. Just unwind it. Hold back. It's okay to do nothing. Sometimes the best thing to do is just nothing. Just sit and wait and let things get clear. In the 90s, when LTCM, Long-Term Capital Management, a major hedge fund collapsed, Warren tried to bail it out with a $250 million rescue offer. In the 2008 financial crisis, when Goldman Sachs was on the verge of collapse, Warren stepped in with $5 billion, securing a deal that earned him a $3 billion profit. Now, some of that was he was pushed into. He was told to go and backstop. Like with Bank of America, he was told to go in and backstop Bank of America. He got a sweetheart deal. He did put up the cash, but it was not his idea. He was pushed up to the edge on that one. But anyway, Warren also partnered with 3G Capital to buy Kraft, Kraft like ketchup, Kraft Heinz, a decision that he justified with one word: ketchup. Shit, I've got ketchup right over there. It's on the floor. I need to clean it. In 2017, Warren tried to acquire Unilever for $143 billion, but the company's board shut him down. So he goes, when he sees things are turbulent, he exits to cash. Things get really murky and gross and turbulent, and he comes back in and he starts buying at a discount with good terms. So he said this time he's not going to save anyone. He's not out there. Warren Buffett officially declares, "I am not Captain Save-A-Ho. Not this time. Not again." So while other investors are scrambling for cover, Warren is sitting back. He's waiting for opportunities, and he's chilling, man. He's doing just fine. He hasn't completely walked away from stocks. In Q4 2024, he opened a position in Constellation Brands, STZ, which is the parent company of Corona Beer. I guess thinking that when people get depressed and they get poor, they drink beer. Not a bad kind of thought process. I kind of see where he's going. They dumped Ulta Beauty, ULTA, just a few quarters after buying it. So apparently he was like, I'm not into beauty. And neither will your wife if you're bankrupt and you lose your job. your wife's not going to the beauty salon 14 times a day. Well, maybe she is, but then you're going to be housing insecure and job insecure and food insecure and wife insecure. Oh man, wife insecure. They're not very diverse. This is not because Warren is more diversified. They're not very diversified. That's one of the things that's always made Warren and Charlie stick out, is they're not super diversified. They choose who they think the winners are going to be, and they kind of let it ride. Warren did hold on to some Apple and Chevron after making pretty big cuts early in the year. He reduced more of his holdings at Bank of America, new holdings, Citigroup. He's pretty much wary of the whole financial sector right now. So there. And no, remember, if any of the stuff, well, no, not right now. Not right now. There are projects. Yeah, there's always stuff we're looking at for the private clients, but nothing that can be converted, nothing that we've leaned into yet. So not quite yet. What are your thoughts on oil as an investment? Man, I don't know anything about the oil market. I know that it's extremely rigged and political. I mean, you have a handful of dudes in the desert that decide how much oil they decide how much oil they're going to print. They'll open the spigot or they'll close it. And to me, I don't want to be on the outside looking in of that market. I know that people aren't driving. I know that they cut production for a long time, hoping they artificially restricted production for a long time, hoping to jack prices back up near 100. And at this point, they're like, we're screwed. So what are they doing? They're opening the spigot again. They don't have a choice. They run dry. The oil is there, but their money done. They're money insecure. The sheiks are Rolls Royce insecure right now. So it's time to open them up, boys. Print that oil. So for me, that's a no-go. It's too rigged of a market. It's too political in nature. It's too many things can happen at 3 a.m. that you can't be prepared. A war over here, an invasion over here, some sheik gets poisoned. Like, no, and no. Too many moving parts for me, brother. Okay, let's see. His largest holding of Coca-Cola, AT&T. I don't know his largest holdings right now, but I know that he likes the Coca-Cola, and he does like the AT&T, but I don't know the percentage of those holdings. So yeah, let's see. I run a food pantry with my church. We're open from 7 to 10. We are empty. Many people are food. Oh yeah, I know. Isn't that terrible? Ugh, God, can you imagine? That'd be awful. Imagine a family with kids and everything. Oh God, that would be awful. I have cats. Listen, if I get to the point where I'm so broke that I can't feed my cats, I'm gonna go get a pistol and I'm gonna go get me some cat food. Ain't no one stopping me from feeding these cats. It might be ugly, but my cats, I will starve before those cats starve. So, well, let's hope it doesn't get to that. Well, you don't have Hoop and Tony. You don't have to compare his opportunity cost. Remember, he didn't not invest over the last 2 years. He just divested himself of a lot of big positions, and all you have to do is look at how much cash he has on the books. He's beating everyone. So, I mean, I don't know what the opportunity cost would only be semantic. The reality is he has $334 billion and no one else does. He has all this cash and everyone else is hemorrhaging. That's the reality. Yeah, it's not invested, but it's also not lost. I think you're missing. You do know what happened in the NASDAQ over the last month, right? You have seen what's been going down, right? Trillions gone, trillions. You think crypto's looking bad? trillions gone. See you later. Bye. Gone. It ain't pretty. It's a bloodletting, I say, a bloodletting. Anyway, yeah, I mean, he won on this one. There's no other side to this coin. On this one, he won. Now you could say, could he have won more? He won. What difference does it make if you win by a mile or you win by a foot? He won. He's winning. He's winning right now. He's winning by a mile. All right. Yeah, well, I leave food out for them all the time. Chunks of delicious chicken. I'm not sure, because that doesn't make any sense. You got to, I mean, I see what you're saying, but that's like saying if he had won the lottery every week, he'd have more money than if he hadn't won the lottery. Yes. No one knows exactly which particular asset to put their money into at any one time. And his strategy, which is slow and steady and greedy when others are fearful and fearful when others are greedy, has earned him the gold medal. So chasing the winner is usually a failed strategy. And this is a lesson that crypto investors could learn. If you're trying to chase the winner, it's a failed bit. You need to play a long game. And it just depends on how long you're. Did you guys know that Warren Buffett was not even a billionaire until he was 56? So for everybody here who's not a billionaire, you probably have some time. You're not 56 yet. Many of you, some of you are. If you are, you're behind. I mean, you're behind Warren Buffett. He wasn't a billionaire till he was 56. Think about that. You have time to do it right. You need to look at investing in that you have time. Now, I say that, then here comes AI. Yes, that is a good argument. That's a good argument for another day. And eventually AGI, and eventually artificial superintelligence or digital superintelligence. Yes, that is true. Those are both good arguments, and those are for another day. But right now, as a competent investor, time. Take your time. Have longer vision. Even if it just means look out 18 to 36 months, rather than 8 to 30 weeks. Have a little vision. Step back a little bit. And yes, winning it is the first part. Not giving it back is the second part. Yep. SPX is up 40%. You're missing the point, Tony. That one index is up 40%. Everybody on Wall Street is getting fucking destroyed. I don't know how to make this argument to you. This is the math. I'm not speculating that he's winning. Warren Buffett fucking won. He already won. So I'm not sure what you're arguing. If he had done this or if he had done that. No, what he did won. He won. It isn't like I wonder how he'll do. He already fucking won. He's the only guy with a treasure trove of cash like this. He's beat everyone. Do you not get this? It's not like a bumper sticker or a speculation. Warren Buffett right now is beating everyone. So it doesn't matter what numbers you pose. He's winning. He's already won. Bro, the gold medal's already been given to him. You go look at the footage. There's no footage to look at. It's not the Zapruder tape. He already won. You're beating a dead horse with your argument. And this argument, actually, you're arguing with yourself, Hoop and Tony. You're basically arguing against long-term value investing. And if that's the case, okay. No, others did not win more. Man, we're done. We're done. Just go have your argument with yourself. He won. He's the only one. It's already over, buddy. Go, whatever. You got it. Good. All right. Anyway, let's call it a day. We'll see you tomorrow. Brandon will be back. Stay in school. Don't do drugs. Don't do things my poor insolvent drunk, strung on a meth grandmother, or Warren Buffett wouldn't do. And I can't imagine what the weather is where Brandon is, but I know that finally the sun has broken through the clouds and LA shall be sunny once more. Bam.